on soon. We'll share our screen. Now they can see what's going on. All came on the same train?
Yep.
Yeah, roughly on the same bus.
Oh gosh, now I've finally gotten a question on mini project number 3. I haven't gotten any other questions. I was just going to say that one convenient way to calculate dividend yield from the CCM data is to use the variable DD, which is dividends paid in those dollars. So therefore, you can calculate dividend yield from just DD divided by the market cap of that stock. So it's very easy to save all the market caps of the stock. So this will give you a dividend yield in percent. That's the easiest way to get it. Same with EBITDA, the enterprise, that you would just calculate EBITDA. Over the market. EBITDA, the enterprise value over the market cap, that will give you the percent. So you calculate EBITDA over dividing by the enterprise value of the market cap. It's the same idea. This is derived, you just include liquidating costs. But anyway, that's the easiest way to get those yields is just to take this, which is in these units, divided by millions of dollars, and those units in yields.
Wait, Professor, I thought dividend yield is dividend divided by price of the stock?
That's dividends per share. Yeah, that's the same thing.
Okay.
Yeah, I don't want to write it down because I don't want to take away from. We have a trading professional here with us, and he's going to be talking to us about directional and systematic trading. And we have just started doing futures and options in here. We've already analyzed Speaker Pelosi's options trades, which she did December 20th.
Oh, that was Micron, Roblox.
Roblox, Micron, I think Google was in there. There was one, there was one limited partnership, which we didn't touch, and maybe there were like 5 positions. Last time we checked,
The Micron one was like 50% in the money. It was basically
all of them were deep in the money. They all had deltas over 70%. And it was.
Roblox doesn't have that delta anymore.
That's right. Now they are even further out, or maybe a little bit closer to being out. So I want to introduce Rangan Padmanabhan. I have known him since 2010 or 2011 when I first met him at one of our UMA conferences, which is a conference we have every year to talk about real life trading and other sort of strategic issues. And we've kept up over the years, and then in the last, I would say, 5 years, he's been nice enough to send me his trades that he does, either looking for a pat on the back or just finding someone who's interested in this stuff. It's not that easy to do unless you go hang out with traders, and then they're a different group to hang out with. But he graduated magna cum laude from Rice with a BA in Economics and Managerial Studies. And he became a financial risk manager certificate holder in '99 and a Chartered Financial Analyst in 2001, which is a big designation. And since then, he's been trading proprietary for firms and so forth. Just some of the files I have from just the last couple of years have to do with asymmetric returns, buying 52-week highs. He sends me daily trade journals. We have other kinds of market on close trades and all kinds of trades set up. And I just realize how far behind I am every time I try to look at one of his trades. So anyway, Rangan, if you could just come up and speak to us about this, I would really appreciate it.
Sure, thank you. Is this working?
Yes, Bill, did we turn it on?
Can you hear me? Okay, great.
Today I want to talk about trading, creating trading systems. I guarantee you this is very conceptually important. It's not the same sexy trading stuff perhaps that I've gone over in the past.
Hit this button down here. There you go.
But I think this is really important because it's the method. The method is more important than any one system or any one edge. Just having a robust way to analyze different things against each other is going to serve you well. And up here, that's my Twitter handle, and I've just started a YouTube channel, and I just started posting things on there just because trading is one of those things where you sit in a room all by yourself and you're going to drive yourself crazy unless you have an outlet. So that's become my latest outlet. So the consistency, well, I guess let me go back a step. Why do we want trading systems? There's either systematic trading or there's discretionary trading. And you can do both. And in all the years I've done this, there is a certain je ne sais quoi to discretionary trading that I don't think a computer can replicate. There's already so many computers mining so much data, taking a lot of the automated stuff away. There's just something about it that I can't quite put my finger on. It comes from experience. It comes from just being able to differentiate different situations. I've had the honor to work with one of the best in discretionary trading, Linda Raschke, and we comment on the same thing, which is, there's no better game than discretionary. And I've felt it. There have been times in my career where everything you do is right. You are just on. And, at least in my experience, what ends up changing over life, for me, is your life situation. You have a family, you have children, you have health concerns, you have family members with health concerns. There's all kinds of things, that make it hard for you to maintain the kind of consistency that a system will maintain. I think about it, had people laugh at me in the past about this analogy, but if you think of Michael Jordan getting ready to play in the finals, I bet that night before he wasn't out partying. His wife didn't bother him with any issues. He didn't take care of his sick kid the night before the finals game. He had someone else do it for him. And because he was about to play the finals game. And discretionary trading is almost like that finals game every single day. You have to maintain the type of routine, the type of normalcy, diet, exercise, everything to be at your peak performance. And that doesn't lend itself well to life because, life is not, does not come that way. But so that's one of the reasons that trading systems are important to create consistency. And with all of this stuff, you're going to create mental models in your head. We all have mental models for the way the world works. We're all just humans adapting, and our life experience, gives us ways to process data. And I would say the same thing, with trading systems. And one of the important things you need to do is really differentiate from investing and trading. They are two completely different things. Investing is there to store and diversify your wealth, augment it if possible. Typically not thinking about leverage. Maybe with real estate there's some leverage, but otherwise, and to arbitrarily measure your wealth in dollars, it's purely arbitrary. Wealth should be measured in time. If you have enough assets such that you've got 30 years of your expenses covered, that's a certain amount of wealth. And if all of that is, $5 million in a bank account and tomorrow the dollar becomes worthless, well, you don't have 30 years of expenses covered anymore. But if you had a little bit of land, a little bit of gold, a little bit of equities, various, diversified things, you probably still have 30 years, maybe 25 years. You have something there. And so, investments can protect you from certain binary outcomes, like, hyperinflation is the one that I would think about. If you've got all your money in the bank account, it could go to zero. If you've got all your money in a trading account, you might have excellent returns year to year to year, but it could all go to zero one night if there's a hyperinflationary event. Things like systemic collapses. If there's a systemic collapse, you may lose certain financial assets. You might lose certain cash assets. It's probably not going to affect your land. It's not going to affect gold you have in your safe. Things like that. With all the stuff going on in the world, think about, we're blessed and lucky to be here. What if we were doing this class in Ukraine at the moment? you have land. Is Russia going to take it over, and is it going to be your land anymore? You know, you have gold in your safe. Is your building going to get blown up today, and you don't have that anymore? You know, and that's kind of where Bitcoin becomes a little interesting, because all your money could be in the you know, wherever Bitcoin is, and you've got the, you know, the code in your head. So that's kind of an interesting, you know, this is probably a, you know, first good test of that scenario. And when you're investing, valuations, fundamentals, diversifications, dividend yields, all that stuff matters when you're investing. Now you have to, you know, you guys are in a place where you're learning all these different things, and you want to be able to categorize things separately. This is completely not that. This is what I'm about to show you with trading systems. You have to almost think of it like a game, and the dollar is your score. And so you do measure it against dollars, because at the end of the day, you know, if you have a trading system, you have a fund running a trading system, you have to show returns in terms of dollars. And the goal is to increase that score with minimal drawdowns, because the better your return to risk ratio, the more leverage you can apply safely to a trading system. And then, you know, trading may protect you from certain market crashes. If you have a certain market conditions, you know, if you have a system that gets you back in cash every night, well, you're probably going to be okay if there was a market crash. You wake up one day and we're down 25%, or I guess limit down, and several days that happens, but it's not necessarily going to protect you from other outcomes like hyperinflation, because your money's all in cash. So with trading, what I'm going to focus on is only using things like price and volume, time of day, just objective inputs, which is kind of different from you know, evaluating things with fundamentals, where you're using a judgment of, well, I think the oil is going to go this way, and because these people don't like these people, and you know, it's going to happen this way. There's a lot more gray areas. So the simplest trading system has two components to it: an edge and a money management program. So an edge basically just means a positive expectation. Oh, and I'm sorry, I forgot one point about this is, as you go forward in your life and your career, I would say align with that which fits your natural demeanor. Not everybody has the natural demeanor to be a trader, and it can be very enticing because of the dopamine, because of the rewards. But if that doesn't fit your natural demeanor, long term you're going to be miserable, you know, and probably not as successful as if you were to pick something that fits your demeanor. And perhaps with investing, you know, that's a totally different demeanor. And they're really just kind of personality, you know, differences, and maybe at different times in your life, a different one may fit better. But that's just something to keep in mind. So if we go on to quite simply what an edge is, right? An edge is just the expected return, which is the probability of a win times the size of your win, minus the probability of a loss times the size of your loss. And for trading systems, what I'll do is I'll introduce a concept called R, where you're measuring your wins in terms of R, which is your risk amount. So if we played a game where we're going to roll a dice, and a 1 or 2 you lose your bet, and a 3, 4, 5, or 6 you win your bet, well, that bet is R. And I just rolled a 3, so you win your bet amount, whatever amount that you bet. And we can very easily calculate what that edge is right here, just with the simple expectation formula. And that just means in this particular game, every time you roll a dice, you expect to make 0.33% of your bet. But of course, it's going to come in a lumpy fashion, you know, in a binary -1 or +1 fashion. But over a large number of rolls, you're going to make 0.33 per roll. So how do we, you know, I'm going to show you the money management and the rest of this trading system in the framework of the dice game. But how do we convert trading into a dice game? Well, we just need to have, you know, everything needs to be very specific. You need a specific precondition as to why you're going to enter a trade, a specific and definable pattern, and your entry and your exit, your entry and your stop need to be defined like a dollar level defined. Because that tells you what your R is, what your risk is. Your exit can either be defined, you know, in an actual number or by an actual condition, but you already know your worst case is your entry minus your stop. So your worst case is already predefined, fixed. Your exit cannot be worse than that. It can only be better than that. And then it's objective, and then you would want to use a large sample size across various market conditions. if you notice that something, works well for all these months, and then all of a sudden it doesn't, and then all of a sudden it does, there's probably a filter out there that you can use to know when you want to use this system and when you don't want to use this system. I forgot to change that sentence there. I don't optimize. I do optimize. I just have I put in another section on optimization. Optimizing is kind of a dirty word, and you have to be very careful with how you do it. The way I like to optimize is rather than randomly telling the computer, go run all these numbers here, and tell me which one's best. If I actually observe something in my day-to-day monitoring of markets, and I say, that looks interesting, I've seen that before, then I'll go back and test that specific condition. So I prefer to do that than just randomly optimizing. So then how are we going to find an edge in the market? Well, I've spent the better part of 20 plus years, probably 8 to 12 hours a day in front of the screen, and you just notice things. You notice things that don't seem random. So when something appears not to be random, gather the relevant data, construct a hypothesis, develop simple rules of how you would take advantage of that and test that hypothesis, analyze your results. If they're great, implement it. If they're not, rework it or scrap it and go on to the next. And I probably got a toolbox of about 70 edges that still work. And it's a lot to maintain in one head. I end up kind of focusing on a few of them. If you, in theory, had the supercomputer, you would have a little bit of capital allocated to each of those 70 systems, and the diversifying effect of that creates a smoother and smoother equity curve for you. And if you think about the edge in a casino game, most casino games like roulette or craps, someone can mathematically calculate what is the house's edge, and I guarantee you these casinos, before putting billions of dollars on it, have already done that, and they know the edge is in their favor, and then they just want to have a lot of people come in and play it, so over time they make money. And that's what we're trying to do, with a system. The key difference being, a casino game is a closed system. A market trading system is not closed, in that something that has worked historically, something that works now, doesn't have to work tomorrow. So you always have to keep that in mind, versus a closed system. So this is a trade. I think I mentioned this in one of my prior presentations, and I just wanted to give you an example of, this is a system that I created probably in 2007 or 8, and it still works to this day. And the way I created it was, I just noticed that the movement in the last 5 minutes of the market is not random. It tends to go up, or down, about 40% of the time, when in reality, 2 raised to 5, 32, it ought to be about 6% of the time that each one of those happens. So, okay, the data you need is 1 minute data over that time, those time periods. My hypothesis is that the last 5 minutes tends to trend with higher lows or lower highs, is what I was testing, as opposed to just the actual close. So how can I take advantage of that? Well, as soon as this bar opens, let's put a buy stop 6 ticks above, let's put a sell stop 6 ticks below. Whichever one takes me in, the other one becomes my initial stop, and then start trailing it. So once this bar is complete and we go on to this bar, I move my stop to 1 tick below this. As soon as this bar starts, this one completes, I'll move my bar, move it here. And that way you just kind of minimize your risk, and over time you're locking in profits, even if you have a one of these bars that it doesn't finish that way, and then just exit right at the final close. So this is just an example of how, just applying scientific method. Here's something that looks non-random. Here's the data I need. How can I take advantage of that? Let's test it. Let's see if it works. And here are a couple of examples. This must have been back post-COVID, yeah, probably April or so, or maybe even during COVID. So it turns out that one of the filters that works well for this trade is the more volatile the day is, the bigger the last move is. And this is a 1 minute chart. This is a 1 minute chart. It should be opened at 29:12.75. So a 6 tick stop would be 29:11.25. And none of these things got violated, right? The higher low, each one of these made a higher low, and that very last bar really pushed up right into 3 o'clock, and it actually closed on the high at 29.5850. So, you know, you essentially, if you bought in 3 ticks higher, that would be 14.25, you know, call it 14 to 58. You made 44 points on a 3-point risk. That's an amazing.
Leave a market on close open that whole time for those 5 minutes?
No, I actually randomly, manually hit the sell market button like maybe a second or two before the close. There are way more sophisticated ways to execute this stuff. I'm just very old school about executing myself. And then here's another example on a day where we had the opposite happen, where we started here and there's no tail on this, so you know there wasn't even any thought of it going the other way. You know, 6 ticks later you're in, and we keep making lower highs, and we closed on the low right there. So 27.60 to 27.23, 37 points, you know, 35 points on 3 points of risk. And then there are going to be plenty of days where you get chopped up and you lose 3 points. You know, or what ends up happening more is you lose less than 3 points because you've trailed, and then you get one of those bars that comes out of order. But you know, and then I haven't even had time or capacity to go anywhere. But a similar thing happens, you know, sometimes in crude oil. This was a month end. I believe this was April 30th. Yeah, this was April 30th, the end of the month trade, and you know, we had this huge move. You know, $17 to $18, you know, $1.60, almost a 10% move in crude, 8 or 9% move in crude in just the last 5 minutes. And again, the reason these things happen is somebody has, you know, there are some large trade based on the close. So someone out in the world is probably helping this get there, and it may cost them money to actually make it get there because they have a way larger bet somewhere else that pays off to make that go somewhere. That's my thing with crude, because you know, like a lot of hedging of tankers and stuff happens on the close. You know, like if I buy a tanker from you now, we say, hey, in this, you know, 2 weeks from now, because you know it's in the middle of the ocean. 2 weeks from now, we'll pick these 3 days, and I'm going to pay the average of the settle on those 3 days.
Yeah.
Well, you've got the incentive to make those 3 days higher, you know, and I have the incentive to make those 3 days lower. If we're both large trading companies, you know, it probably nets out. If you're just a provider, you know, a producer that digs up from the ground, doesn't trade, maybe, you know, the party that has the trading operation takes advantage of that. And then, you know, my mental model for why this happens in stocks is, you know, think about how much money is just indexed to the S&P 500. And, you know, when the market is really volatile, you have people hitting sell or buy on their 401k. And, you know, whenever you hit buy or sell on a mutual fund, it tells you will get a 4 p.m. close today. So as we get closer and closer to 4 p.m., you know, Vanguard, Fidelity, all these guys, they know, hey, I've got 10 billion to sell or I've got 10 billion to buy, and they can't risk misexecuting. You know, if the close was exactly 3,000 and they, you know, they're trying to sell and they only achieve 29.98, that's, you know, on $10 billion, that's a $6 billion risk there. And they have razor thin margins on index funds, you know, very low expense ratios. So, you know, my working theory of what they do is they, he, she, they or them, guarantee, you know, they work with an executioner that guarantees the closing price. So it's like a prearranged deal where you need $10 billion of this, and I say, I will give you the closing price, whatever that price is. It's floating right now. We don't know what that price is. But now when you give me that order, I'm incentivized to step it up at an accelerating pace and make it close, like if you're buying, close it exactly on the high, and that becomes the price of our transaction. And along the way, I actually achieved a lower price getting there. And vice versa, if you're selling it to me, you know, and if we go back to those charts, you'll see how the volume accelerates, you know, from 255, 56, 57, 58, 259, that volume accelerates and just kind of really put your foot on the gas, because whatever that price is what Fidelity gets or Vanguard gets, you know, which again, you know, like in the oil example, mom and pop buying 401k, buying or selling mutual funds has no pricing power. That executioner who's handling that very large order over that very small period of time gets to sort of push it the way, you know, that benefits them.
Isn't that kind of like putting a swap out there?
Yeah, so the prearranged deal we have where you're going to get the close, that's essentially a swap. And then the way that I would hedge that is by pushing it into the close, and I have futures, then your futures and your swap will net out, risk-wise. But then
The execution people.
yeah, as of the execution people, right? So this is, and that's my theory, right? I have no idea that that's actually what's going on out there. I have friends that had worked for other funds before that have explained things similar to this, but this makes complete sense to me because ever since I've had a 401k, it always gives you the 4 o'clock price, and so that's just my mental model for why this period of time is non-random, and and there was a counter to this is typically after there's a good MOC move, the first few minutes of after the close bounce back up. And my mental model for that is if I'm stepping on it, and all of a sudden like let's say I know that I need to sell 50,000 contracts, that's the amount that I'm going to owe Fidelity. I step on it, and somewhere down here I'm losing control because there's another force, maybe a fund, maybe a sovereign fund, someone else is coming in and trying to buy the close. I would step on it extra hard. I'm just putting myself in their head. I don't do this. If anyone's watching, I don't do this. I'm just putting myself in the head of who the executioner are doing this. I would step on it and put an extra 10,000 in and sell 60,000, and then take a loss and buy back that 10,000 because the 50,000 is going to get set at this price. So if that 50,000, if I don't step on it and that pops up to here, I'm going to lose a lot of money. So I would make sure it closes down here and then worry about it, pretty soon right thereafter. So now what if we change the dice game? So all of this was to just tell you how we convert a trading system, that we've observed and developed into the dice game. So we can have certain stats that say it wins X% of time. When you win, you get this many Rs. When you lose that many Rs. And then test it over a long period of time. Now, what if we change the game? Now, if you roll a 1 or a 2, you're going to win 3 times your bet. If you roll a 3, 4, 5, or 6, you're going to lose your bet. So the edge is still the same, 0.33. So is this better or worse than the last game? Anyone have an idea?
Maybe the same.
Same. So from an expectation standpoint, it is the same. Now, when you look at streaks, if you're winning 1/3 of the time and losing 2/3 of the time, I just did a quick simulation of 250 trades, and it came out this way, where you have streaks of 0 to 5, right? You're losing 2/3 of the time, and the biggest streak you had was 5 wins. Now, if you had the other situation where you're winning 2/3 of the time and losing 1/3 of the time, your streaks look like this, where again 1/3 of the time you're losing, but then your streaks went all the way up to 13, and there's quite a bit of long streaks in there. Again, here you're only winning 1 unit. Here you're winning 3 units. So there's another way to address these types of things, and this I think is probably as it says, the definitive guide on position sizing strategies. I did find it very definitive. The frequency of trade is important, and he has something called an SQN 100, which is a normalized trade, and game 1 has a higher SQN than game 2 because although the expectation is the same, the standard deviation is twice as high when you have that 3 - 1 versus the 1-1 situation. And and part of what I wanted to impart here is that the edge itself is not that important. People focus so much on the edge and oh wow, this is 63% winner. Oh well, if I spend another 4 months on it, I can make it a 65% winner. That's far less important. Now we'll go into the money management part. Here's a system that I have in development right now, and it only wins 50% of the time. And it's only profitable 55% of the days, but it has a daily SQN 100 number greater than 3. And part of this is a lot of it has a large number of trades, which helps smooth things out, but that's a pretty nice looking equity curve over the course of a year. Not that many drawdowns, and just slow and steady eddy. So this is an example of the SQN being a good measure. A lot of people look at something like that's called profit factor. That's a pretty mediocre profit factor. But that's not a mediocre chart. I think the difference is, using some sort of method of stabilizing the standard deviation of your expected return. If you want to get into more details with optimization and evaluating trading systems, this is like I consider this to be like the textbook on that. It's very, very technical. Now, like early in my career, it was actually my first internship at Rice. I worked for a company, I'll leave them nameless, but they were building trading systems. And one of the things they did was, it was very simple moving average type trading systems. And they had, various parameters for what's the first moving average, what's the second moving average. There were probably 4 or 5 different parameters. And they optimized to the tune of 5 or 6 million different things, and they found something that worked well. Then they put real money on it and started doing it, and they lost like $5 or $6 million pretty quickly. And so that was a significant milestone in my career to learn. And they later implemented it properly. I mean, you can look at the significance of what you're doing versus randomness. If the odds of it being random are 1 in 5 million, and then you try 5 million parameters, all of a sudden your odds of it being random went up a lot. So your odds, if your odds of it being random are 1 in 5 million and you try 100 things, that's probably okay. And in general, it's the experience I've had. Simpler is better. It's more robust, has a longer shelf life. So yeah. Oh, and I had a fun. I forgot to take notes for myself here. Back on the MOC trade, had a fun anecdote. I remember. Forgot exactly what year it was. It might have been 2008 or it might have been 2010. I was skiing in Mount Hood. So I have a teacher that I go skiing with. This guy was my 8th grade algebra teacher. He was my 6th grade gym teacher. Had him for various classes, 7th, 8th, 9th. We've met all over the world to go skiing. He's a very, very good skier. I just remember it was a time of market volatility, and I just kind of timed, my descent from the mountain with enough time to get to the car, open up the laptop, have this little Verizon MiFi thing, and I just remember like I just knew the conditions were good in the market for this one little trade. So it's like, well, it's a little bit of an inconvenience, but for this little 5-minute period, made $3,000 or $4,000. And it's funny. I'm sitting in the back of my thing with my boots on, boom, 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 done. Put your boots back on, go back up the mountain. This has been robust. I've been trading it since 07, 08. I'm sure it was there long before I've done it. I still trade it at times. It still works. And when you think of the shelf life of a system, you have to ask yourself the other part of it, which is how, what is the inefficiency on the other side of this that's allowing this to persist? And the inefficiency is just the structural way in which people buy mutual funds. They all get the close factor. So if that rule changes in the future for some, maybe they could go to a VWAP, where the volume weighted average price throughout the day is the price you get. That, I don't want to give anyone any ideas, but there's a structural reason for why that inefficiency exists. So back to Pardo. So now let's talk about money management. Now, I've kind of given it away. Money management aspect of this is more important. And by money management, I mean position sizing. Sometimes money management means your financial advisor that throws you in 60-40 stocks and bonds. But we're talking about money management in the term of like a bankroll management. If you were at a casino and managing your bankroll. So here's a game I want everyone to play along with. We're going back to the first game. 1, 2, 3, 4. In fact, I think I have it backwards, but whatever. 1, 2, 3, 4. You win your bet. 5, 6. You lose your bet. And I'm going to give you $100 to start to play with. Right? That's all the money you have. At this casino. So obviously, God, this is an amazing game. You want to be able to partake in this game, especially when it's a closed system with the dice. So let's do a few rolls, and everybody write down how much you would bet on the very first roll. And then I'll tell you what the roll is. So if you've written down your amount, the first roll was a 6, so you lost your bet. Then think again, now that you've lost your bet, subtract that from your $100. How much are you going to bet on this next roll? It's 5. I'm a bad roller. Okay, it's a 5, so you lost your bet again. So now, subtract that number again and write down what you're going to bet on this third roll. It's 5.
Lost our money quickly.
Exactly. And then, so do the same thing. A 4. So you won this time. So add your bet to there and decide how much you're going to bet on the 5th roll here. It's a 1. And you won. Do the same thing. 4. You won.
We're even.
Do the same thing. 1. You won. Let's do one more here. 2. So you won. So we had kind of a streak of 3 losers and then 4 or 5 winners. I'm not sure how many times I did it. So how much did everyone bet on that first roll? 5? 1? 2?
Wait, so how much money?
How much did you bet on the first roll?
How much money to begin with again?
100.
I bet 66.
You bet 66?
Yes.
Okay, wow, you got a gambler. What did you bet on the second roll?
I always bet 2/3 of the total amount.
Bet 2/3 of the total amount.
For some reason.
Okay, okay.
Yeah, I don't have the time to fully rationale my choices, but it's fine.
Yeah. So, a couple of questions come to mind, like how many times do I get to play this game? If I can play this game as fast as I can roll for as long as I live, well, crap, bet $1, you'll never lose. You're going to just build that up forever. You can play exactly 30 times before this game closes. Okay, there's a different answer for that. It might be 66.
Bad rolls.
Yeah, bad rolls. So what did happen to you after the second roll then? Oh, you always do 66.
Yeah, I always do like 66.
Okay, so you'll never go bankrupt technically because,
But the amount gets smaller.
yeah, because the bet gets smaller and smaller. So there's 2 different ways to bet. One is called martingale and one is anti-martingale. So martingale is, you might have heard the story of the guy that goes and plays blackjack. I lose, I'm gonna double my bet. Lose, I'm gonna double my bet. Lose, I'm gonna double my bet. And he eventually breaks even. If he has the staying power, he, she, they, them, has the staying power to, keep doubling until they get back to even, which is part of the reason, they put table limits in there. So what we want to do is not martingale. Martingale is destruction, very destructive. Very few people can stay the course of that mentally. And then also, typically the big money is managed money. You're managing other people's money, especially when there's one layer of separation like that. No investor is going to let you do this type of thing, and you shouldn't be doing it. You don't need to do it. So here's a quote. Paul Tudor Jones, amazing guy, has been around for a very, very long time. And it's so great when when you hear him talk, what he says sounds so simple. And it is simple, and it's, I'm sure there's a lot more complexity to things in the way he handles them, but he just understands things so well that he can explain them so simply. And what he's basically describing here is an anti-martingale strategy. Where he keeps reducing his size, and that way, when he's trading his worst, he's trading the smallest size possible. So, we've eliminated martingale strategies. We have even betting, and we have anti-martingale strategies. I think this is where I'm supposed to go to Excel. Or no, here, I've got another page here. The 2 anti-martingale strategies I'm going to look at here, one is called fixed fractional money management. And this is basically what you were doing. You're betting a fixed percentage of your bankroll on each trade. It's good for a large account, and it's a more gradual anti-martingale strategy. And then fixed ratio money management, this one is where you bet a fixed amount plus X% of accumulated gains. And what this does is this is more reactive. When you're on a winning streak, your bet size increases automatically. When you're on a losing streak, the same, that's just anti-martingale. The same applies to both. It's just more pronounced here. And this is good for small accounts because it quickly adjusts, and within a few trades when you have one streak, you'll ramp it up faster. So I'm going to take a look at these simulations, and basically, the inputs are your win rate, your win outcome, your loss outcome, and the percentage of capital you risk on each trade. With fixed ratio, there's just one more thing, which is your increasing factor, your plus X percent. That X is one more factor. Okay, yeah, that was my artwork. We'll go to that next, but let me go to the Excel sheet then. This here. And I did this, again, a simulation over 250 days. Oops, go back to this one first. Can you see that? Okay. Now, if we do a fixed fractional with 0, that's basically even betting. You're betting $1,000 each time, right? This is your risk amount. And if I hit F9, this will just resimulate a bunch of things. And we know that flat betting, you should make about, our edge is 0.33 times 250 trades, we should make 83,333. And so if we start with 100,000, in this simulation we made under 160. And yeah, so keep paying attention to the scale here, 180, 170, we're getting more than that. Oh, there we go, here we finally got a little bit more than that. When I just kind of run through and do a bunch of these, sometimes you end up with about 160 to 200 because you're even betting. Now let's go to fixed fractional, and we're just going to bet 1% of our thing. And again, the win rate is 66%. And you can see that the numbers are climbing over 200, 180. We got to 200, 200. And some of these will pop in even higher. There's 250, we got above 250. And the volatility of this, the range of this is greater than the fixed betting, and we do end up positively getting better. That's over 300,000, that last one. This one's close to 300. And if we change something like this, 2%, and all of a sudden, we're looking at numbers like 500, 700, 450, 500. And again, you could simulate this 1,000 times and make yourself a nice little distribution to understand it better. Then I wanted to go to fixed ratio. Now, if you set this to something small like 5%, all of a sudden, again, you started with the same $1,000 bet, but when you catch those win streaks, you do so much better. And so there we go, that one hit $1 million. That one hit 1.2 million. This one's 1.2 million, 900. And this one's over 1.4 million. 5% is very conservative. In practice, I use something closer to 20%. And I mean, this gets ridiculous, right? Because the casino's not going to sit around and let you win that much money. The liquidity in your market is not going to be that much. But all of this is tempered. All of this is tempered by the fact that if you're trading your own money, that's one thing. If you're trading other people's money, they like to see a statement every month.
Yeah.
And let's say this was the end of the month, and they're so happy that you were up, 500% or whatever. And then let's say this is the end of the next month, and they're like, "What? You're down 30%?" And you lose all your investors. So the practical way of doing that is you can use a factor like 20%, but you're basically resetting every month or every quarter, depending on the expectations of the people who are watching what you're doing.
Yeah.
But in all my work, 20 has kind of worked out to be optimal. Let's go back to fixed fractional with a 66% bet. And, it's a little too high. Oh, wow, it's 5 billion. Hopefully you would have stopped at 4 billion, and like I said, you technically never go bankrupt.
Yeah.
It just kind of asymptotes down there.
Okay, Dr. Padmanabhan,
Yes.
soon to be Dr. Padmanabhan. So let's say you're in fact trading this for other people's money. Now you take it from 180 and it pops up to 700, don't you take $500,000 of that and put it in the bank somewhere? What is the equivalent to doing that when you're trading other people's?
That is kind of, that's an emotional construct, right? It's not a mathematical construct. I mean, it makes sense, it makes sense to the human, the emotional. So again, this goes back to being clear in your mind as to what you're doing. If your goal is, wow, I just wanted to make $500,000, I made it, and you left the casino at 4 billion, great, But if
you don't stop there, you keep doing it.
Yeah.
Year after year after year.
Yeah. So, you can define it, and the thing I've learned the most in trading is there's a million ways to successfully do it. Every single one of those ways requires very specifically defining what you're going to do and what you're going to do at each stop. Like almost making a decision tree ahead of time to know what you're going to do. If you're up 500, okay, I'm going to take it out and put it in the bank. That has to be predefined, and if you don't have rules, the market will suck you in and destroy you. Now, here's a really interesting thing to using these things also. If we go back to even betting, which means a factor of 0. So this dice game or a casino is a closed system. The market is not an open system. It's not a closed system. What if you had a programming error and your system actually doesn't work? What if the market completely changes and your system doesn't work? Well, that would mean your edge is less than 67. So let's say your edge is 40%. Well, if you're even betting, well, yeah, that's what you expect. You're going to run yourself into the ground. And the way to see if this goes to the ground is just say you never win, and you go straight into the ground. Well, I guess I didn't put in a min to stop you at your bankroll. Now, what happens with fixed fractional if you had misunderstood your system and you actually don't have an edge? Well, at 67%, obviously, but at even at 1%. 1%, it looks kind of like the other thing, like a steady roll down. It's actually not as bad as even betting because your bet size is still decreasing. So let's give this a 0, and you can see that we're asymptoting around, I don't know, call it 10,000 or something. Let me do a bunch of simulations and see. Oh yeah, all of the simulations. Oh, well, because there's no variation with a 0 win rate. Yeah. Let's give it a win rate for fun. And it just moves ever so slightly. Right? There's not a lot of thing there. So even betting runs you into the ground. Fixed fractional basically runs you into the ground. If you've only got 10,000 left, that's pretty bad. Now let's take a look at fixed fractional. Let's set this factor to 5%. And we can even set this to 0 to see where it asymptotes. It asymptotes at 80,000. It protected you from having a bad system. And then if you increase this factor to 10%, you asymptote at 90,000. It protected you even further. You raise this to 20%, it asymptoted you at 95,000. So what if I told you, trade whatever system you want, be mediocrely sure that it's kind of good, who cares, apply this money management. I know after 250 trades if your system's good or bad. Because if you are exactly using this money management system, you start with 100,000 and you're at 95,000, your system didn't work. And that's just a whole nother way to protect capital when you're looking at a lot of different systems or different people, to have this kind of built-in, in addition to giving you the upside. So let's go back to a system where we win 66% of the time. You've got $1.4 billion of upside, not practically because, margin and liquidity constraints, but you've got all this kind of upside, and then all of a sudden your system goes to heck, and it protected you at 95%. I mean, you get to maintain 95% of your capital. So that's kind of the gist of money management.
What happens at 0.5 for a win rate?
0.5 for a win rate?
You get a nice...
It ought to be fairly random.
Let's see.
There's a bunch of simulations. So, it's all going to depend on the streak, but then eventually there's no edge in the system, and it asymptotes down. Is that right? Let's see, +1, -1 at 50%. Yeah. So okay, now even betting would probably keep you around the even mark. Right, because even betting, without taking into account commissions and slippage and all that, should just put you around 100,000. So in that situation, this does take you down to 95, your worst case scenario, even with an even system. But change this to 51%.
You accidentally deleted the first model, the first time.
Oh, let's make this 51% and 20%. And I guess that's maybe not good enough of an edge, or 55, just so we can see it within 250 trades. There you go.
Still.
So yeah. And I envision these as, my skills aren't so great, so I just drew these. But if you did even betting, you have the tightest distribution around your expected value.
Yeah.
If you do fixed fractional, well, you kind of have a wider distribution and you have more upside. And the virtue of these fat tails pushes your mean to the right. And then you do fixed fractional, it's the longest tail, where we saw some of those really positive outcomes, and those positive outcomes really shift your mean further right. So when you think about, I think my first presentation where I was talking about asymmetry in the markets, you want asymmetry in the market you're in, you want asymmetry in your trading system, you want asymmetry in your position sizing. And you kind of throw all that asymmetry together, and right tail things tend to happen for you. So yeah, just another way to look at asymmetry.
Do most fund management, risk management officers do this kind of plots and stuff?
I don't know. Very few people that I've met that manage money understand this. The people that I've met, I have a friend who manages a good sum of money, and he may not do simulations like this, but when he describes what he does, that's exactly what he's doing. When he's down, he's taking smaller bets to dig himself out. When he's up, he's swinging with the house's money. So just conceptually, that is the way to do it. And so it makes me, when I think back and try to analyze what edges he has, well, it really doesn't matter because he's going to cut the tail off if he keeps losing. I mean, it does matter, but it matters less knowing that he's got that mentality. And there's all kinds of things that lead to people that perhaps do it the other way. Everything from perfectionism to, oh my God, I'm down 1%. Let me go risk 50% of my account to make that 1% back. And you're taking a really bad risk, just because you have an issue with seeing a minus 1%. And then sometimes having those layers where you have investors that are putting, undue pressure on you can also affect the way a manager performs. I would imagine the more successful people do this in some variety, whether it be intuitively risk more when they're up, intuitively risk less when they're down, or if they have it modeled out like this. But what's nice about this is there's no question, right? If we're doing a fixed ratio, let's go back to our example of, if we look at the MOC trade, the risk is 3 points, which is $150 per contract. You do 6 contracts. Okay, well here, do 5 contracts. Here, do 4 contracts. Here, do 5 contracts. Here, do 4 contracts. Do 4 plus 5, right? I mean, and then as you get up here, oh, okay, my risk is $150, do 21 contracts. And this ahead of time, right? Because if this MOC trade is the only thing you do, yesterday you walked away with that amount of money, you ran your spreadsheet, it said risk this amount, you're sitting around all day waiting until 2:55 p.m. and you know that I'm gonna hit the button with 21 contracts.
Yeah.
And it gets more complicated if you have various systems that are all in the same pool of capital, all that kind of stuff. But this is the simplest construct for one system, one strategy. And I would argue that how much you bet on each trade is the most important factor, more so than, because, let's just say we're even betting a 75% system. We get a little bit over 200,000. Now let's say, okay, well the system's only 66%, but we're doing fixed ratio money management on it, and you had much higher outcomes. And let's do a smaller number just so we can see more granularity. You know, you're still got above that 200 and something here, 700 and something. You know, I mean, let's drop it to 60% win rate. And you know, maybe it takes a little bit longer to catch that streak, but once you get that streak, you know, it all goes back to those streaks all the way up to 13. You know, have one of those while you're increasing your bet size, and you just get one of these phase shifts in your P&L. And you know, maybe you have to just grind win loss, win loss, win win loss, win loss loss, win loss win loss. All the stuff is grinding, but over the course of 250 trades, you hit that win 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 win. I mean, let's see what the data point here. This is 193. 209, so you had 16 wins in a row. And you know, that happens once in a while over 250 streaks, and it's over those streaks that you end up making a big chunk of it. So it's gonna end with a philosophical note. I thought I might, it wasn't long enough. I could take some questions, but I was afraid that I tend to get long-winded. Does anyone have any questions about stuff?
So I guess at the end of that, I'm sorry, you got to jump in when you got an exciting speaker like this.
Yeah.
So at the end of the day, for a trading system, your standard is whatever the cash in your account is, whatever the equity curve. That's your criterion function.
Yeah, that's your measurement, is your equity curve. So, you know, think of it as a, do you ever play blackjack?
Not particularly.
At a casino? Yeah. So if you walk into a casino with $1,000 and, you know, you're playing, you grind down to $500, you're probably not playing as big, because you've got X amount of time left before your flight, and you're like, hey, I still want to be able to play the rest of the weekend. And then vice versa, if you just got lucky and you're up 2, 3, 4, well, you might find yourself taking bigger bets, because this is the house's money.
Yeah.
And it's just kind of the same concept. The difference there is you don't have an edge against the casino, whereas in this, you know, in theory, you do have an edge. And what I used to do, you know, back when I was trading heavily, if I had a rut in trading where, you know, when you have a rut in trading, you're supposed to just keep doing the same thing. You know, your position sizing algorithm is telling you how to size it. Your trade system itself tells you what the entry, exit, all that stuff is. You're supposed to just keep going. But human nature is, God, this isn't working. I don't want to do it and take another loss today. That's all just the human psychology. I would actually go to Vegas or Lake Charles and go play blackjack. And the reason I play blackjack is because I count cards, and that is now a closed system that is in your favor, and you're just getting the repetitive behavior of understanding that all I'm supposed to do is keep doing what I'm supposed to do, and now I'm getting the positive feedback that I'm winning. And so sometimes just my psyche needed that reinforcement that when I was hitting a rut in the market and doing what I'm supposed to do and it's still not working, I need to go somewhere where I'm getting the positive reinforcement that doing what I'm gonna do is gonna work, and that's in a closed system. I'm sorry, got your question.
Well, it raised a lot more good ones. Any other? Wait, we got some more time here.
Yeah, I have a question. So whenever you have a trading system, you want to trade on something. So how do you decide to trade on what? Like, is it that you design the trading system based on what you trade, or is it usually the other way around?
Like, how do you develop a trading system?
No, like, once you have a trading system, what do you trade? And how do you decide on it?
Okay, so your trading system should tell you, like, for example, this MOC system says every day at 2:55, this is the trade you take.
Yes.
I have certain filters that say, hey, if the volume is such, if the volatility has been such, if it's a special day like the end of the month, like options expiration, those are better than other normal days, because you think of a day like options expiration, somebody's got an incentive to push it one way or the other, because they have options worth way more than the underlying that are being settled based on that price. So if those conditions are met, you should take it every time.
Yeah, may I ask for a definition of MOC?
What's that?
May I ask for a definition of MOC? Because I'm not...
Oh, I'm sorry. MOC just means market on close. And that's just the name that I give the trade. It's not technically market on, it's not a market on close order. but I just call it the MOC trade because it's basically the order imbalance at the end of the day that's getting all resolved in that 5-minute period for people that want the close.
So do you trade on market index for that?
Yeah, like these charts I think were the S&P 500 futures. That one was crude oil, but yeah, these were this was S&P 500 futures.
Gotcha.
And I would imagine a similar thing goes on for the Nasdaq, but perhaps the indexing is more to S&P. Same thing happens in crude. I've noticed it in crude before. In natural gas, on contract expirations, it happens, but otherwise, I haven't seen it happen a whole lot. And again, there's like a world of things that you can test this way. It probably works on certain individual stocks. If a fund needs to buy X amount of a stock on the close, things like this could happen into there. But so this just opens up, one idea that can be spread in a lot of different ways. So if had a ton of resources, at my disposal, we could test this on a bunch of different markets, and there may even be a market better than the S&P that this reacts on. And just because the S&P is going down, down, down on its close, I mean, first of all, crude's close is 130. The pit closes at 130 versus S&P closing at 3 o'clock. So if all you did was this one trade all day long, well, you're kind of sitting on capital all day, then you're putting it to work for 5 minutes, and then you're done. Well, you can use that capital again for 5 minutes at this time, and all of a sudden you've increased the rate of return on your pool of capital. And perhaps the DAX, when that closes at 10:30 Central or 11:30, depending on the time zones, daylight savings, that's a third one you could add to the list, and it doesn't take any more capital to make that money if it has an edge and you can trade it the same way. And then all of a sudden you've basically tripled the type of returns that you're making on your pool of capital because you've got 3 separate trades that are non-overlapping. But the majority of stuff that I do is called price action and technical analysis. On my YouTube channel, I've started posting some of the edges that I trade, and a lot of it has some of the stuff I showed you in the last class, where a very simple bar-by-bar method of watching when daily higher highs or daily lower lows are made, and then looking to a shorter time frame to catch a counter trend pattern that you can then get your gains in the size of the daily direction, but your risk is really limited to that 15, 30-minute, 5-minute chart based on that pattern. That's what I've been working on a lot more now. Just as I get older, I really don't trade that much anymore. I do some consulting. I have a fund. I've got almost have 4 kids at this point, and there's just other things in life that want to work on. But what I like about that 2 time frame system that I've done several videos now on the YouTube channel is just that there's a little bit of time and focus to set it up, but once you set it up, you let it go because it's either going to hit your target or hit your stop. And treat it like a roll of the dice. It's binary. Okay, 6. It hit stop this time. I lost. But then apply the money management on how you risk for the next time. And between those 2 things, I think that that gives me something that maybe takes 30 minutes of my time in the morning to actually stalk the actual pattern, and then I can just let it go and do the rest of the things that I'm trying to do. But that you have to fit something again that fits your demeanor. This is a 1-minute chart, right? If you fumble with a mouse, this probably isn't for you. If you know how to program it, that's probably even better for you. And maybe in 10 years, this will be really hard for me to do. Everything kind of changes, and it goes back to stay aligned with your demeanor, and I think that's when you'll have the most success. And going back to that question earlier of what wealth is, this was just one of my favorite quotes on real wealth, and that's too small to read. But it's kind of philosophical. And it's funny, I found it in a book called The Hedge Fund Edge by Mark Boucher. But the thing about markets, at least for me, and maybe that's how I know that trading in markets is the right path for me, I'm very passionate about it. And every time I develop a new edge, it just excites me because to me, it's just like, wow, this is an infinite source of wealth in the world. And the rest of it is just your own demons. You know, if you don't follow your own rules, if you risk too much, if you risk too little, if you are inconsistent, you know, the rest of it is controllable. Those are controllables. And are always thinking, always growing. And I hope this is something I can, you know, continue to do until I'm 70, because it just, you know, keep your mind working. You know, certain things change, certain things always stay the same. And I think there's always a way, you know, applying scientific method to anything will always find a little edge for you in whatever you're trying to do, whether it be trading, whether it be starting a business, whether, you know, and the information is different. If you're trying to start a business, you probably learn about advertising, you probably learn about clicks and Google and how to do all that stuff. And that's part of the reason I started the YouTube channel, is I want to learn how that works on the back end. And it's something that I watched forever, and I just figured I got to jump in and do something to see all the analytics they have on that. But yeah.
Are there any other questions?
Yes?
I was wondering, is there a similar thing to the MOC that happens at Open, since that's kind of one of the biggest periods of movement?
You know, there possibly is. One system that I have on the list to test, which, you know, I have a very long list and very little time, and it actually happened today. I don't know if I could pull up today's prices on this, probably not. But so this is something I got from a guy named Peter Resnicek. He does a lot of stuff with market profile, which is looking at the volume distribution of where the S&P trades or any market. When you gap out of the true range of the previous day, so today yesterday we had a certain range in the S&P, the NASDAQ. I was watching the NASDAQ this morning more closely. We gapped above yesterday's high. When you gap completely out of that range, the first trade of the day typically goes counter to the direction of that gap. So one way to do that, you could say, once that first minute bar is printed, I'm going to sell stop below that 1 minute bar with a stop above it. And today that would have returned like 8 times your risk. Would have been huge. You know, it doesn't always work, but you know, there are also certain other conditions, like you want to look at what the overnight trading did. So if, you know, the majority of the market got caught off guard and was short, then maybe that wouldn't necessarily happen. Maybe it would continue to burn higher. If it was kind of a more balanced thing and it just kind of happened early. And part of that is, so again, these are so look behind the numbers and behind the conventional stuff and think about what creates these edges. Well, there's a certain type of person who's trading in pre-market. There's a different type of person who's trading from 8:30 forward. Certain people may not have a mandate to trade before the pit opens. Certain people have a mandate to do whatever they want. Certain people, you know, maybe just focus on this and then they have a day job, you know, or maybe their fund focuses specifically on that less liquid time. So there's kind of a changing of guard at 8:30. And so whoever rode this up, they're all thinking, well, let me take my profits. I did great today. And they initially start to sell down. And maybe you have a bunch of eager people like, oh my God, a gap up, I'm missing out, I can't do anything till 8:30, I'm missing out. And then they jump in at 8:30 and get flushed. So, you know, just like the structural thing with the MOC trade where, okay, mutual funds get that 3 p.m. close. It's often these kind of structural differences that lead to edges that will persist over time. So I haven't discovered anything that's as straightforward as this, you know, with the trending, but that's one of the things that, you know, on the open, which, you know, gapping out of the range maybe only happens 1 in 5 days. But, you know, again, you could do that on crude. You know, crude has its own pit session. You can do that on natural gas. You can do that on S&P, NASDAQ. You know, all three of them probably trade very similar. All of the indices probably trade similarly. But yeah.
I would like to point out that if you were to go to one of these presentations hosted by one of the exchanges, CME or somebody like that, or the Association of Technical Traders, these would be thousands of dollar seminars to have an instructor like Rangan go through what he's talking about. So thank you very much. So I guess now we go put out whatever fires we got when we start. Thank you. Wasn't that just exceptional? I mean, if you don't know anything about trading, you know, you probably want to learn it now. Especially that $3,000 in 5 minutes thing, that's pretty nice.
Yeah.
Yeah, so let's see, let's invite him back. If I have 1 to 3, we 1 to 2, we don't invite him back. 4 to 6, we invite him back. 5, we invite you. That's it, guys. You guys can have fun.